Hello, and thank you for viewing our latest video. I'm Bob Fontana, Chief Investment Officer for Investors Trust, and I'm joined today by my colleague, Deeds Kienker. A lot has happened since our last written quarterly commentary, so we thought it was appropriate to prepare this short mid-quarter update video. I'm going to briefly discuss recent economic data, which have suggested the U.S. economy may not be growing as fast as originally hoped for. Deeds will then be talking about the impact that has had on the fixed income markets, and I will conclude with our current views of the equity markets. So with that, let me dive right in to discuss recent economic data. While the U.S. economy continues to recover from the pandemic, the pace of that recovery has started to come into question. This graph here shows quarterly economic growth. And we've highlighted that the preliminary estimate for economic growth in the second quarter, which is still subject to revision, it came in at 6.5%. And that was only slightly higher than the first quarter's 6.3% and well below expectations that just a couple of months ago called for growth pushing 10%. A number of factors have been cited for this, including the Delta variant, although that seems to be more of a July and August event, which is third quarter, not the second quarter. But other factors include rising labor costs and rising inflation. Economists' forecasts have not yet changed, still calling for 6.5% growth for the full year, though it is quite possible that these forecasts will be lowered as data are digested. The possible driver for slower than expected growth could come from consumers. This graph here shows consumer sentiment, and the preliminary consumer sentiment for August dropped sharply, hitting its lowest level in 10 years and actually hitting levels that were even below April 2020, which is outright stunning to us considering where we are today relative to where we were in April of 2020. Surprisingly, the decline in sentiment was less due to the Delta variant and more due to lowered expectations for economic growth in the future, largely tied to rising inflation. For July, the year-over-year increase in consumer prices was 5.4%. That's the highest level in over a decade. The consumption data itself has been okay thus far, although just this morning, retail sales for July came in showing a decline of over 1%, which was worse than expected. So we are watchful to see if this decline in consumer sentiment is indeed going to start to impact actual consumption activity. Deeds, with this less robust economic activity, how has this been impacting the fixed income markets?
Yeah, that's a great question, Bob. Well, as you can see from this chart of the 10-year Treasury yield, it had a very, very strong run for several months after setting an all-time low in August of 2020. But yields started trending lower right around the end of the first quarter of this year. This recent downtrend is explained by some of the factors that you mentioned, Bob, like lower growth expectations, waning consumer confidence, and the unstable rebound in the labor market. More recently, as you mentioned, another big driver of lower rates has also been fears that the fast-spreading Delta variant could derail the economic recovery. But the biggest take from all of this is that these lower rates are really putting fixed income investors in a tough spot to generate sufficient income and attractive returns in their portfolios. Despite this recent trend, we still expect that robust U.S. economic growth, higher inflation, and the Fed tapering asset purchases at some point to all be catalysts for a renewed uptrend in yields. And in that type of environment, the best approach for fixed income investors is a multi-sector strategy, which includes allocations to securities like inflation-linked bonds like TIPS, which perform well when inflation is rising, as well as short duration and credit-sensitive sectors like short-term corporate bonds, leveraged loans, high-yield bonds, emerging markets, and preferred stock, which typically offer much higher yields than government bonds. And as you can see from this chart here, historically do well when growth is strong and rates are rising. And by the way, this strategy has been significantly outperforming the Barclays Aggregate Index over the last 12 months. So with that being said, Bob, what are some of your thoughts on the equity market?
Yeah, thanks, Deeds. In our quarterly commentary, we were cautiously optimistic on the equity markets for the balance of the year, largely because we felt that there was no alternative to equities, or as we called it, the TINA market. There is no alternative to equities. With yields low and likely rising, the bond markets are not particularly appealing, especially given the strength in corporate earnings. Companies are finishing up now reporting their earnings for the second quarter, and those earnings have been downright robust. As a result, earnings growth for this year is now expected to be roughly 45%. That's up from 37% just in early July and up from roughly 23% at the beginning of the year. Earnings growth is really what has kept the markets moving higher this year. Our pause point has been valuation, which has remained elevated for quite some time. We would expect higher valuation levels given low interest rates and the sheer strength of earnings growth. As we look ahead, we see that earnings growth for 2022 has actually started to come down. That has certainly caught our attention. It is now estimated that earnings growth in 2022 will be around 9%. That's down from 11% just a couple of months ago and 16% at the beginning of the year. The valuation of the market based on 2022 estimates is roughly 20.8 times, which is above historical averages. So on balance, our struggle is the tug of war between strong corporate earnings on one hand, combined with declining growth likely for 2022, and valuation levels that already reflect a lot of positive news on the other hand. We have kept our clients fully invested to their equity allocation targets for the year, and that has been the right decision so far. For the time being, we continue to think that it is the right decision to do for our clients. In conclusion, thank you again for joining us on the video. We thank you for the trust that you have placed in us to help you meet your financial goals. If you have any additional questions or you would like to talk about your account, your portfolio specifically, please do not hesitate to reach out to your wealth advisor or to us directly. Thank you.